Hello, everybody. Kirk Spano. It is November 4th. There's something going on this week, and I'm not quite sure what it could be. Something I have to watch on TV. I think I have to run an errand. I don't remember. In any case, here we are. Oh, election. The stock market could see a sell the news election event. So I covered here in this article on Seeking Alpha, which I'd love for you to read. Click on it. What's going on in the stock market. And we have a lot of valuation issues. This is the forward PE. This is the backwards PE. This is the current PE of the stock market, 29.22. As you can see, it's high, but it's not as high as it's ever been. So you've got an overvalued market, but not record setting, right? That means it could go a little higher. It could even get up here. I think it might, but I think there's something else. Here's your price to book. This is the one that bothers me a little bit. I don't like this price to book ratio way up here of 5. Oof. It's supposed to be between 2 and 3 usually. See that over here. And in the QE age, and especially since the COVID bailouts, really big time price to book ratios, similar to .com crash. I do think we're going to get a pullback here. I talk about it in this article. Nothing horrific, just kind of bringing us in line. And I think there's a strong argument based on the fact that half the economy is technology driven now, that your price to book ratios probably will be 3 to 4 in the future versus 2 to 3. It makes sense that that would happen because margins will be higher. So you can pay a little bit more price to book because you know that the businesses are good and the margins are higher. So while this is high, I think down in here, it's probably fine. The world changes. Take a look at your different metrics. Crestmont, if you've never visited Crestmont Research, take a look at it. Very nice website. And they explain how markets work in a cyclical way, meaning that we can get a very long bull market or a series of bull markets with only small corrections or very fast, sharp corrections, and then you go right back to bull market. But we've also had flat periods in the market or periods that drift down 4, 6, 7, 8, 9, 10 years. Doesn't happen often. It's happened 3 times since Great Depression. And there's a lot of speculation that the S&P 500 is getting close to entering one of those periods. I would suspect it'd be kind of 28, 29, 30. If I had to figure out a spot where I thought the market would round trip or not go up for an extended period of time, kind of like the .com crash, where there was a peak, a trough, and then a long recovery period, where after 3 years, you were in about the same spot, and you really didn't have gains for 5, 6, 7 years. I could see that near the end of the decade. You've heard that story before. Right now, we're overvalued. And again, maybe some overvaluation is okay because of the technology-driven economy. The Q ratio and the cyclical PE 10, this one is basically Shiller. So the Shiller ratio, the red one, is the one that's pretty good for forecasting the next 5 to 10 years. It's not as high as it was here in 2000 during the 2021 COVID relief rally, but it's higher than the financial crisis. So last time we really got blown up was the financial crisis. Everything else has just been a speed bump. Will this red line get up here? I don't know. But if it does, if it gets in this area, it eclipses this spot here, be careful. So as the Shiller gets up to about here, got to be careful, even more careful than we normally are. And then up here, I think you're very active sellers. Again, this is based on the average PE, which is going to be a little bit higher. So you can give it a little bit more wiggle room. But if the average PE looking forward over 10 years and looking back over 10 years is out of whack, you usually have a period of digestion and bringing those ratios back to normal. So either a long flat period or choppy period or just a very big correction. 2000, we kind of got both. Buffett indicator, which might indicate why Warren Buffett has raised over $300 billion, selling 2/3 of his Apple stake because the valuation of stocks to the economy, to the GDP, is getting pretty high again. Not like it was in 2021 or .com, but higher than a financial crisis. And people ask, well, why didn't the financial crisis get that high? Because this was a lot of hot leveraged money, a lot of leverage in the economy. We're not anywhere close to that kind of leverage in the economy right now. More debt, but not as much leverage. Somewhere there's an equation which will make it all make sense. I haven't found it yet. But I do believe that this number can be close to this yellow line almost in perpetuity. But as you get towards the orange line, you start to get a lot of trouble. We haven't seen this before. That would be the short of the millennium if it got up there. But as it closes in on this area, right, where its top was in the 60s, busted it here. As we get into this range, just like with the Schiller PE, you have to be questioning, well, how can equities be so forward looking? If the prices get too high, then you're not making money for years against the economy and the economic value that is created. Margin of safety comes from buying valuable assets when they're not fully priced, when they have reasonable valuations against the future expectations. So as these go up, more and more problems occur, fewer and fewer bargains happen. And I think what Buffett is doing is he understands that, he bought Apple about a decade ago, a little bit after I did. He held it much longer than I did. The idea is that Apple is near the top of its S curve. What does that mean? That means it'll have some growth, but not a lot of growth, right? It's not a 20 to 30% grower every year anymore. It's probably a high single-digit grower, which is all right. Beats the economy, but you're paying full price for it. Again, I'll talk about efficient and inefficient markets. An efficient market means that pretty much everything is priced in because everybody knows everything, and there's a lot of everybody. Large caps and mega caps, indexes, all very efficient. Inefficiency, which is where you can really find value a lot of times, are in the small and mid caps, certain industry versus sector, certain countries versus regions, because people just don't know everything that they need to know. And how many investors knew a few years ago when I was talking about it, that India had a lot of things going in their favor, including demographics and technology, right? All you heard Western investors say is, oh, they got that caste system and a lot of bureaucracy. Oh, talking point. And then their stock market doubled. Inefficiency leads to volatility, leads to the next word. Come on. Somebody knows the word opportunity. Elliott Stevens on the mark today. Yeah. Inefficiency leads to volatility, leads to opportunity. Sometimes the opportunity lasts longer than we want it because we buy too early. But if you can buy the volatility a year ahead of the market, really recognizing the value in something and making it efficient, you're going to do really well. And people try to think that they're going to buy a month ahead of time. Right? I'm going to get in right before those earnings go up. Man, you don't know that. And you don't know when some guy with $1 billion checkbook is going to say, ooh, gobble, gobble, gobble. I like that. If you can identify the catalysts over the next few years and get in one of those trough periods and then do what Charlie Munger said, which was the money is made in the waiting, and you allow the crowd, as you see them coming over the hill, coming, and they finally get to you and they pick you up and they carry you up the mountain. That's what you're looking for. All these folks who trade in large cap stocks think they're getting safety. And the reality is that most of the large cap stocks are completely tied to the economy. The correlation is over 90%. And what does that mean? That means that as soon as the economy rolls over, these stocks get destroyed. And they're destroyed well before the economy bottoms. And you actually have to buy them back before it turns up. So if you're in large caps, you are generally just tied to the economy, which is tied to what? Interest rates and unemployment, monetary conditions and unemployment. The best leading indicator of the economy is unemployment. When unemployment starts to tick up heavily, sell almost everything. I don't mean a quarter point or a half point. I mean a point or 2 points or 3 points, heading up to unemployment rates over 7%. That seems to be the Armageddon zombie apocalypse scenario. Anytime unemployment starts to make a run at 7, and you should be able to identify that before it happens, before it actually gets to 7. If it goes from 3.5 to 3.8 to 4.2 to 4.7, get the hell out of Dodge. Because as we know, the government doesn't really plan that far ahead when it comes to the economy. They act based on short-termism because that's what gets them elected. And there is a general plan over the long term that The bureaucracy keeps mostly in place. But as far as the elected officials go, they just wait for crisis that they're partially responsible for causing, and then they let no crisis go, past, because, hey, you never let a good crisis go to waste. And then they treat the symptom usually instead of treating the disease. So the valuations that we see being high probably should be a little higher than historical because the technology has changed everything that much. However, prices get too far ahead of themselves, in summary, then there's just no margin of safety anymore. And you have to wait too long. And if you have to wait too long, bad things can happen. You need to keep everything on that 1 to 5 year range, right? That's your outlook. Your outlook is next year and the next several years. Can't predict out much more than 5, 6, 7 years when it comes to stock prices, even though we can be optimistic about the long term. Technicals, back at the end of 2021, I told you when market breadth gets up here, pretty much everything's done going up. This is the percent of stocks above the 200-day moving average. Right before the financial crisis, a series of corrections that led to more QE, 2021, 2018, right? A lot of stocks above their 200-day moving average, and then we had all those events in 2018. If you overlay the S&P 500 on here, the correlation is pretty clear. Anytime you get to around 80% of the stocks over their 200-day moving average, right? 2014, we got that 2.5 year period where stocks didn't go up. So everything gradually came down below their moving average. Anytime this number gets to around 80%, you're going to get a correction. We got up to 91% in 2021. And at the end of the year, I wrote 3 or 4 articles. There was 5 articles if you include the ones in January of 2022 telling you to sell. I think we get a pullback here that's not particularly steep, and then we see this expand up to 80 over the next few years. 2028, we will see what happens. That'll either be the 4th year for Harris or the 4th year for Trump. If it's Harris, I think that we kind of skate through, and then we have to deal with the boomer peak retirement in 29 and 30 when the most boomers will be on Medicare and Social Security. If it's Trump, you've heard me talking about the private credit problems that seem to be in the 3rd or 4th inning, right? When we get to the 8th and 9th inning, there are going to be some short trades to make because a lot of these private equity firms and other financial institutions that I'm really afraid are going to get too entrenched into the economy, they could have really big problems as their 5-year notes come due starting in about 2028, because this private credit boom started a couple of years ago. But now we're starting to pull in very unsophisticated money into private credit, and that's just a recipe for people sticking their greedy little fingers in there so they get paid today and they worry about tomorrow, or they leave the job before the problems start, right? Why not make a commission today if the problem isn't for 5 years? I'll quit in 4. There's a lot of that out there, and it's going on right now. Private credit is going to be a major problem at some point, most likely. If we avoid it, then the regulators are doing an amazing job. I only see the regulators doing an amazing job if Harris wins, because Trump is already talking about getting rid of the main regulator, putting in a laissez-faire person, kind of like Greenspan did. How'd that work out? So when I talk to you, I want you to start thinking certain ways. And I have this up at Fundamental Trends too. I just copy and paste. And I want you to have a mindset about how to invest. And how to invest is to think about what really gets paid. Is it the widget maker who has a lot of competition that makes a lot of money on the widgets? If it's not greasy little hamburgers, probably not. Even the coffee guys have had some problems. So think about this analogy. When you take your car to the mechanic and pay for a repair, what is the most high margin part of the repair that's going on? Are you paying a ton of money for the parts? Are you paying a ton of money for the labor and maybe even the testing, right? They hook your car up to a machine that gives it a report. You know how much that costs them? Maybe $1, maybe. What do they charge you? If you got a nice mechanic, maybe 60 or 75 bucks. A lot of times it's in the hundreds. It's a pretty good margin, 60 to 1, right? That machine's been paid for a long time. You need brakes on your car. $300 for rotors and calipers and pads. Wholesale, you probably could have got it for $250. But then they charge you $140 an hour based on a book rate of a 2-hour job that they end up doing in 45 minutes. That's where the money is. The money's in services and subscriptions, recurring revenues. Widgets are just widgets. Economic term if you ever took an econ class. So if the widgets are subject to lots of competition and contracting margins, is that really where you want to put a lot of your money? No, the only time you want to buy a widget is if that widget is so good and protected by patent that it's hard to copy and hard to drive the pricing power down on. Contracting margins. If you can avoid contracting margins, you'll do well. Somebody asked in the chat about a company that makes a type of semiconductor. I know that it's a highly competitive industry. So the question I asked, I didn't know a lot about the company, was, do they have something that protects them? Is it differentiated in a way that it's not easily copied and the margins aren't easily compressed? And the answer seems to be maybe. I don't know yet. I have to do the deeper dive. I just don't know. There seems to be a lot of demand for that type of widget, that type of semiconductor, gallium-based semiconductor. It transfers power at a lower temperature, and I don't know, a bunch of other stuff that's above my pay grade, and I'm going to have to do some reading on. What I don't know is if it's protected by patent in a way that will keep competition away for a while, or if somebody can just tweak the idea and have their own thing and basically produce a similar product at a lower price, right? That's the risk. So here's an example of a company that we own that has a widget that seems to be better. And that's Enovix, a battery with a different type of architecture. Now, it does also have different chemistry, but that doesn't matter too much. It's the architecture that is unique. Chemistries can be tweaked. You ever heard the term biosimilar? Chemistries are rarely unique in a way that they can't be pretty closely copied and avoid patent infringement. But architecture, hard to copy that, especially when there's hundreds of patents protecting it. And Enovix has an architecture of their battery, the shape of the inside of the battery, that's different than the shape of other batteries. Most batteries are coiled. This one is like bricks. I think that's the best way to describe it. So it's a different architecture. It's protected by patent for the next 17, 18 years, which means what? They could spend a lot of money to keep on building plants, or they could license it out to companies that need a battery that is 30 to 50% more efficient and doesn't catch on fire like lithium batteries do. What industry can you think of going through a major transition in fits and starts and stops and accelerations? That's a hint. What industry needs a better battery? And they also need to keep employing their people, because as they take them off the assembly line to build an internal combustion engine car, the EV doesn't need as many people building it. So because of the deals with unions and their labor, other than the attrition, they need to find roles for those younger employees. They transition them over to building batteries. Work the AI and the machines that make the other machines that make the batteries. So Enovix, because of the structure of the EV market and the battery market in general, for utilities or whoever, home battery, right? You don't want a home battery that can catch on fire. They can license the technology out, let all the other manufacturers that are already set up build it, and then just collect a VIG, recurring revenue. It's like a subscription. So the way you think about investing is important. Now, going into the election, I think that today and tomorrow, you really want to write a lot of covered calls. Why? Because I do think, and I would love for you to click on this over on the Seeking Alpha Premium side that you should have. We might see a sell the news event here this week and next week and for the next couple of weeks. So as you know, if women are 53% of the vote, Kamala Harris wins. If women are 51% of the vote, Donald Trump wins. If women are 52% of the vote, well, then we're going to have another really close election that we have to wait until Saturday for. We'll see what happens. But from what I can tell, women are coming out to vote. We'll see. And that means that a lot of the profits in the stock market that have been pulled forward, driving those valuations up, peeking out some of the technical signals, but not all. You could have a market that just sighs, just a big deep breath for a month or two. People reposition for whatever they think the taxes will be like, tariffs or no tariffs, whatever. I think you see some churn in the market through about Christmas. So this is a gap in growth that I think is likely, where you could write covered calls and collect a premium during this 6-8 week period where maybe the market doesn't go up much. or drops. And then all those covered calls expire and you just have that money in your pocket. But wait, Kirk, what if the stock market goes up 5 or 6 or 7% into the end of the year? It might. In which case, we have gotten to that point where a bunch of these charts have really gotten obnoxious. And you want to sell then anyway. So if they don't get called away, you win because prices didn't go up much and you got to collect all that premium. And if prices do go up, you win because you sell into really high valuations, right? Nice equation. It's hard to lose right now with covered calls. So I covered the 3 reasons to sell covered calls. It has to do with things I cover in the election and just filling that gap, right? By selling covered calls, you get paid for holding through what could be a rough patch. But here's the kicker. If your stocks appear likely to get called away on a rally, if there's no correction, then you're probably selling high. That's good too. And if something that you want to hold on to looks like it's getting called away in a week or so, just roll the covered call out a couple months and a couple dollars higher. Then maybe you sell higher and you collect a little bit more premium. So when you scan the market using TradingView, and this is the S&P 500, you see that a lot of stocks are overbought. Oops, a lot of stocks are overbought. This is a weekly reading of relative strength index, RSI. What does a weekly reading mean? That it's the closing value at the end of the week rather than the end of the day or hourly or every 15 minutes, right? So the longer time period you measure, and I'm measuring weeks here, the longer time frame it applies to, and it's a much stronger signal. If you go out the monthly, anything that's overbought on monthly is almost always a sell, and I'll show you that in a second. But this is the weekly reading. I use 9 weeks. Has a little bit something to do with turtle trading. If you want to Google turtle trading and look up who they are, great. And this is the momentum is up, but the oscillator, we're overlaying multiple signals to see what the rate of change is in the signal. Is it bending up or is it starting to flatten or bend down? If it's flattening, it turns neutral. If it's actually starting to turn down, it's a sell. And that's a negative divergence, meaning that these will typically follow suit in coming weeks. Fiserv, GE Vernova, United Airlines, Entergy, Philip Morris, sell signals. Their curves are starting to bend down. Then all these neutrals. You don't even get any buys until way down here. Palantir. I wanted to show you Palantir. That might not be on this one. Well, we'll get to it. But what you're seeing here is all of these with a high RSI, because they're large cap, they're relatively efficient. Talked about that earlier. Your smarter traders are starting to trim, right? They just play the math. And I will tell you, based on the comments that I see in Seeking Alpha articles and other articles, we still have close to 80% of the people who A, don't understand valuations, and B, for sure don't understand technicals. Or I think the case is they don't understand valuations and they don't care about technicals. That's just voodoo. Okay. I will say it again. If you don't respect the technicals, you're going to make mistakes. The times that I have made mistakes, those red numbers on my coverage of my history, it's when I tried to outsmart the technicals. What you really want to look for is these divergences. And at those times, if you can validate your thesis, that might be a price point to buy at or sell if you're wrong, or if you think something's supposed to go down, right? It works in both directions. So virtually everything on here you could sell a covered call on until you get these ones where it says buy, in which case they're probably going to keep going up for a while. So here are a few covered calls I think you can sell on stocks that we have owned recently, or some of you might own because they were on my lists. AAOI, I've already sold the December 20s. All of these trades should be January covered calls, I think, because you get a little extra money and it's before the next earnings. I think you can sell these January covered calls. And if the market dips into December, go ahead and close the position for a profit if you want to. Intel, let's take a look at some of the charts actually. So here's AAOI, right? We bought it down in here. I think we actually bought it in 2 spots. And will it break out of this range and get above 20? Maybe. Chart's inconclusive. This right here is iffy. This is iffy. That's iffy, right? The RSI is getting close to 70. So if you sell the covered call at 20, if it gets called away, you're probably okay. If it starts to break out, then you just got to roll it and sell some cash secured puts as well. And a lot of times you're making 2 or 3 transactions on these options, but you're bringing in premium. So even if this stock ran away from you, you could just keep rolling it out at higher prices. Eventually there'll be a correction or a pause. So rolling out your covered calls typically will work out for you. It won't be as good as just owning it outright, but you're still making a couple bucks. Spire Global, you have to write a December 14 because there aren't Januaries right now, which is weird. But that coincides with the warrant pricing. So you can keep writing the 14s till it starts to get closer to 14. And then the next resistance is in the low 20s. Bristol Myers, which we just talked about a few months ago, has had a bit of a rally, right? Looks like it's going to either pause or correct before resuming an uptrend. But it's a pharma stock, so this could take time. So you could sell the covered call here, make a couple bucks, and then if it dips, you can decide what you want to do. If it moves sideways, you can decide what you want to do. If it goes higher, probably this is a great one to roll out because eventually it'll get a correction. Unless, they come up with a drug ahead of schedule. But I have looked at that. So all of these are stocks that you can sell covered calls on with the idea that you still have to manage the position and think to yourself, okay, if it gets close to being called away, am I okay with that? Or should I roll it? So that's the way I look at it. Also, I am right around 20% cash holdings right now on aggregate. And I don't think, especially if you're conservative, not a horrible idea to push that higher than 20%, maybe 30 to 40%. Again, I covered the valuations earlier. We're not at a point yet where everything is screaming collapse. And we know that the economy is probably going to be good for a few years as interest rates come down, as private credit finances things, as money comes out of money markets and goes into development. We are seeing residential and industrial building booms. And pretty soon the commercial real estate buildings and some of the hotels, but mainly the commercial real estate buildings, are going to be turned into mixed use with condos on the top floors, maybe a couple floors of offices, maybe some WeWork-like things, right? You own a condo on the 10th floor, maybe the second and third or the third and fourth floor have some sort of office space so that you don't have to work directly from home. You can actually have a business office address below where you live. I actually love that idea, actually. I'd love to have a 10th or 20th floor condo with a good view, amenities, a big deck so I can grow my plants, and then have an office on a third or fourth floor. So I don't have to sit at home when I work, right? I can actually have that professional atmosphere. Those types of buildings are being built now, are being remodeled now, and I think there's a wave of them coming. So if you're an urban person, I think there's going to be some pretty neat things that develop over the next 4 years, 5 years. It's happening in Milwaukee. I just saw it in Dallas. San Francisco doesn't seem to be quite there yet, but I know that there were 6 or 7 buildings that are for sale right now. And I think some of them will take that approach. So a lot of building going to happen over the next several years at really every level. Again, I don't know what happens when that building wave is over. I don't know how the private credit shakes out. I don't know how bad it gets on the Social Security and Medicare payments. Right? I don't know what we're going to have to do around 2030. I suspect it's 10 to 20 trillion dollars of QE. So if we can finesse that year, that down year, or 2 down years, or 3 down years, we can avoid getting blown up when that happens, then buy closer to the bottom again, right? That's the next big giant macro trade that I see. I think it gets worse sooner under Trump. I think it still has a rough patch, but maybe a little later under Harris. I don't know that we can avoid it under either. Just a story of magnitude and timing. And what do we have to do to fix it? How big of a bailout are we going to need? I would say probably as big as COVID, which was, I think, over $11 trillion, according to official estimates. And when you talk to the people who, are good with spreadsheets and understanding what really happened, it was probably closer to 15 trillion, especially when you add in the bills that came in later years, infrastructure, semiconductor, IRA, and the partial bailouts of the student loan system. So the next few years, though, even if the indexes don't do great, there's going to be pockets of growth. Got to follow the money now. It's not going to be just throw it in SPY and let the market work for you. I think the big winners are going to be your mid-cap stocks, It's your combination of growth and safety. You can find some home runs in the small caps and micro caps, but the mid caps are probably where we want to play the most. There are a few stocks out there in the large cap universe that seem like values, and you only get that value because everybody hates them right now. But as soon as the numbers start becoming good and big investors get in, then your first wave of followers get in. By the time these stocks really go up a lot, all of a sudden people love them again. So if you can anticipate that on an Intel, maybe a Warner Brothers, pains me to say that every time. You can find value in the large caps occasionally, maybe Nutrien, but finding a good company that's unappreciated among large caps, it's tough. Everybody knows about the large caps. You got to find where the sentiment is wrong, where they don't value something that's there. Ford, talk about Ford all the time. Someday people are going to go, oh, well, that Ford's a pretty damn good company. We'll see when that is. Well, all right then. So let's call it a day. Everybody get out and vote. We will see what happens later this week. My guess is that whoever wins Pennsylvania is the next president. We should know that tomorrow night. Late, it'll be late. It might be Wednesday, but I think we know what's going on by Wednesday night. So on Wednesday night, we do have the macro and major markets with me and Shooter and Teresa. So come back Wednesday night and we'll talk about it. All right. Have a great couple of days. Don't freak out about anything.